Good afternoon, and thanks for joining us for today's Construction Accounting and Tax Update webinar. I'm Dan Sturm, partner and leader of our firm's AEC practice, Principal Tim Showers, Principal Aaron Stagliano, Senior Manager Kelly Koman, and Manager Zach Starner will also be joining me in today's presentation. For those of you who don't know, McKonly Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, and Bloomsburg. We provide a range of services to organizations across a variety of industries, as you can see on the screen, and we encourage you to visit our website to learn more. If you've joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics and keep you updated on what's going on around us. Be sure to check out our website to catch past presentations as well as current information through our blog. If you have questions for us during today's presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during or after the webinar. For those of you that are looking to obtain CPE credit for today's webinar, please keep in mind that there will be 4 polling questions throughout today's presentation, and you'll need to answer all 4 of those questions to get your certificate via email a few weeks after the webinar. And we'll give a few moments to answer this first polling question. Also joining us today are Jesse and Aaron from KBKG to discuss 179D and the future of green building tax incentives. We're very excited to have Jesse and Aaron joining us today. KBKG focuses on value-added tax services. If you hear anything on today's presentation that you think may apply to your business, we will provide their contact information at the end of the presentation. With that, I will turn the presentation over to Jesse and Aaron, and I really appreciate you guys being here today.
Thank you so much, Dan. My name is Aaron Massey. I head up the Mid-Atlantic practice for KBKG. I'm based in Philadelphia, and we're thrilled to be here today. I just wanted to give a couple-minute intro into KBKG and what we do, and then we'll hand it over to Jesse. So as Dan mentioned, KBKG is a specialty tax consulting firm. We focus exclusively on tax credits and incentives, and we typically work as a complement to CPA firms. We're a national firm with a strong regional presence. Some of our service lines are the R&D tax credit, which I'm sure a lot of you are familiar with. We spent quite a bit of time with ERC. There was a ton of confusion in that space. And then we do cost segregation and then green energy tax credits, which we're going to talk about today. I'm going to let my colleague Jesse Stanley do the bulk of the presentation, but the overarching theme here is to discuss updates stemming from the Inflation Reduction Act that had a specific benefit for construction firms. So with that, I am going to pass the mic on to my colleague, Jesse Stanley.
Thank you, Aaron. Very nice to be speaking to you all today. So my name is Jesse Stanley. I lead our 170 practice. I'm a licensed professional engineer in about 40 different states. And together with the rest of our 170 team, we've been providing 170 services for about the last 10 years and have helped taxpayers claim these benefits on over 2 billion square feet of commercial buildings across the US. So to get started, many folks are unaware of what 179 capital D is. It's the energy efficient commercial building tax credit. And it was originally created back in 2005 as part of the Energy Policy Act. At that point, it was available just to commercial building owners, and it was an incentive for commercial building owners building energy efficient commercial buildings in the US. And it was only available to commercial building owners. Fast forward a few years to 2008 during the financial crisis, and 170 was modified at that point because the construction industry kind of came to a halt, and there needed to be a stimulus to help incentivize and keep architecture firms, engineering firms, construction companies keep their doors open and keep them focused on helping make buildings in America more energy efficient. At the same time, the US government is the single largest owner of buildings in America between federal, state, and local buildings. So Congress modified 179D to allow for government-owned buildings to allocate their tax deduction to designers of their buildings. So at that point, both commercial buildings could directly take 179D as accelerated depreciation, and designers of government-owned buildings could receive an allocation and take that tax deduction for their work on those buildings. It was a very popular incentive, but it was on a temporary basis. And so it was extended at 1, 2, and 3 year increments up until 2020 when it was made permanent. And now there was significant changes to it in 2022 through the Inflation Reduction Act, which we'll talk about. So here's a case study of the potential impact this can have. Here's a mechanical engineering firm that worked on 3 buildings over the course of a few different years. So they worked on one building that was completed in 2020. There was a 175,000 square foot building. It was eligible for, at that point, the maximum benefit amount, which was $1.80 per square foot, which created a $315,000 tax deduction. They also finished 2 other buildings in 2023. One was 320,000, and the other was 215,000 square feet. And given the increase in benefit amount from the Inflation Reduction Act, those 2 buildings generated another $2.5 million of tax deductions. So as you can see, even 3 eligible buildings can result in a significant tax deduction available for a business.
Hey, Jesse, real quick, sorry to interrupt, but as Aaron and I were talking about topics and things like that for this session, it sounded like you guys are seeing a lot of activity with 179D. At this point, do you see any specific things driving recent activity, or is it just more awareness of the guidance and opportunities?
You know, it's twofold. One of the components is the Inflation Reduction Act really raised the benefit amount pretty significantly. So this is how it used to track, and it was up to $1.80 per square foot as the maximum amount. So a 100,000 square foot building could have a $180,000 tax deduction. But last year, the passing of the Inflation Reduction Act changed that amount up to $5 a square foot. So now that same building, instead of 180,000 in deductions, could be $500,000 in deductions. So that has really put a lot of impact on this and made it much more exciting for folks to be considering. The other thing that we're finding is and I think some of this comes back to the fact that it was temporary in nature, it's still not well understood and it's not well pursued across the building community, the building industries. So that's the other fact that we're seeing is hopefully now the increased financial impact can help drive further education, because we often see this as there are benefits that just aren't taken and are not being pursued at all.
So when do you see any kind of theme or pattern in the clients that you're serving that maybe you're surprised they haven't picked up something sooner? Was it something that triggered them to have the discussion? Like, do you see any patterns with that, or is it just more awareness from sessions like this?
There's a combination of types of clients that are now very excited. So what I see is most of the time, most architecture firms either don't fully understand 179D and are not pursuing it, or maybe understood it in its first inception and haven't followed and tracked the changes. So they may understand what it looked like here on this slide, where it was, you know, just up to $1.80 or just available to commercial building owners, but don't realize that they, as a designer of these buildings, can receive the benefit coming back to them. So that's a huge thing that we're seeing, is that architecture firms, engineering firms were unaware that they could actually benefit from this. The other thing that we're seeing as kind of this awakening is that commercial building owners maybe took cost segregation 5-10 years ago and never knew about 179D and thought about it, but they're starting to wake up to it and pursue it today for buildings they built 5-10 years ago. Some of that, I think, is coming from the fact that as interest rates have gone up, the value of dollars has really risen. So if companies are sitting on, you've got a portfolio of buildings, and you never took 179D, you've got a piggy bank that you can break into. So that's very attractive to many, both business owners, be them architects, engineers, construction companies, or commercial real estate firms with big portfolios of buildings. They can look at 179D to really bring dollars back to their business that may be more valuable now than they were 3 years ago with different interest rates.
So anyone on the, if I'm hearing you correctly, anyone on this call that whether it's they're building something new or they've engineered or they've been an architect for a building, this could absolutely apply, is what I'm hearing.
You're absolutely right. You're absolutely right. So this slide shows a couple of these changes. So one of them is that used to be that it was just government-owned buildings that could allocate deductions. So as of last year now, based on the Inflation Reduction Act, all of these tax-exempt organizations can also allocate tax deductions. So that's nonprofits, private schools, private universities, and many architecture firms or engineering firms that didn't do a lot of government work may have done a lot of nonprofit work. So now all of a sudden they're eligible for something they didn't think about before. So that's something that we're seeing. There's this prevailing wage component, which is going to be tracking in the future how folks are paid as they're designing or as they're building and putting together the construction of different buildings. And that's something that we're going to be looking at in future years. But there's a safe harbor that exists. So if you've built buildings in 21, 22, and they're finishing in 23 or later, you can avoid having to comply with any prevailing wage requirements, which we're seeing across our commercial real estate clients is very, very attractive. So really to summarize this, 170 can be much more impactful than people think about. So if you own a large portfolio of buildings or you are functioning in a design capacity, be it an architecture firm, mechanical engineering firm, electrical engineering firm, there may be huge benefits from considering 179D that may have been missed in the past. So last piece here on this slide, going from $1.88 up to $5 per square foot. That is a huge increase. One piece to touch on is if you are a designer, to take 179D, you have to receive an allocation for that project. So this is a unique component of 179D where typically this happens on a first come, first served basis. So whoever has a 179D provider in place that's going to be pursuing this probably has the highest chance of actually getting that tax benefit. You may have 4 or 5 eligible designers, but the first one to have a 170 provider in place to pursue that allocation letter is going to be the one that actually gets the allocation. And every company that comes afterwards, maybe 6 months later, a year later, and knocks on the door for an allocation from the government or nonprofit building owner, they may lose out because they didn't have a plan in place to secure their 170 deductions. So this first come, first serve component of 179D does create a race, does create urgency. So that's something that we want to make sure that folks fully understand. We at KBKG do help architects, engineering firms, construction companies to pursue allocation letters in advance for projects that are under construction today, so that once they're finished, you've already secured the benefit and you don't have to, consider winning the race at that point, since we've gotten it before that project completed. Now, again, just to reiterate that point, a 179D building finished last year in 22 could have had a benefit of $470,000. That same building, that same middle school, being completed this year, hitting the same energy standards, would go from $470,000 to $1.25 million. So this is what's driving that increased interest, because the benefit amounts jumped so much. Additionally, Congress made it better for the taxpayer, because instead of having a max amount and partial deductions, it's a simplified process. So if you hit 25% savings, and as you ratchet up percent by percent, you're going to be eligible for more dollars per square foot. So it used to be you had to get 50% energy cost savings to get that $1.80. Now, if you get 25% energy savings, you're already eligible for $2.50. And then every percent more that you get is more money coming back to your building. So much more advantageous for a taxpayer. Again, another little summary here. 3 new construction buildings finished in 2022. they would have been $2.8 million in tax deductions, which is absolutely worth pursuing. That's a huge amount of money. But in 2023, those same 3 buildings, the benefit is $7.5 million in tax deductions for having designed those government-owned buildings. So significant increase.
So it sounds like most of this gets back to design as well. So do you see a lot of your clients involving you on the front end of the conversation, so they understand what in the design is going to drive the credit?
We see that sometimes, and that's great when that's the case. But we'll work with an architecture firm or engineering firm to understand, as a first step, what are all the things you designed that were put into service over the last 3 or 4 years? And then what are all the things that you're currently working on or that are currently designing, and to set them up for years of tax savings into the future. And we're happy to have conversations to help guide them through what they should be doing if it's a big project, and they need some guidance on how to really make that 179D as impactful as possible.
Timing related question for you as well, Jesse, since it sounds like 1/1/23 is such a key date. In terms of having a project qualify for that, is it key that the project finish in 2023, or is it key, like, let's say that my role in the project, is in the earlier stages, like in the design phase, and my role is wrapped up and now it's in the building phase? Just curious as to how that's viewed from a timing standpoint in the context of the transition of the available credit and things like that.
Yeah, that's a great point. And so there is kind of a timing difference here. So, let's say that you're an architecture firm. You may be working on the design in 2018, and that building may be finished construction where it receives its certificate of occupancy in 2020. And we're going to look at it based on when that building received its certificate of occupancy date to determine when it was placed in service. So when we're working with clients and we're looking at, because right now you can go as far back as whatever tax year you can amend. So for many clients, that's buildings that were completed in 2020, but we'll often ask them, hey, what were you designing in 2017, 2018? Because maybe it was finishing in 2020, 2021, and is an eligible project to take a deduction on today. So there's that big window of amendable tax years to look backwards, as well as projects that we're pursuing future for clients. Whereas like we've got a project now in airport for an architecture firm we've secured that's going to finish in 2026, right? So there's this big window of design projects that they can secure benefits for. Okay, so prevailing wages are going to be important in the future. So if a project is paying for prevailing wages as it's being built, you're going to be eligible for larger benefit amounts. If you're paying market rate construction and you're breaking ground this year or later, there'll be a reduced benefit amount. But there is a safe harbor in place. So any projects that begin construction in 2021, 2022, all the way up to January 29th of 2023, those projects get grandfathered in to being eligible for that $5 without having to pay prevailing wages. There's also a second pathway that was just created, which helps really old buildings that are undergoing renovations to have a second shot at deductions. So this is really helpful if you do a lot of historic renovations and you make improvements. You have this second pathway now where you may actually have even bigger savings than you would have under normal 179D. Another really positive change here for taxpayers, you used to only be able to claim a 179D deduction once in the life of a building. So if you built it in 2010 and you took the deduction and then you renovate it years later, you can't take it again. But they fixed that. So now a commercial building owned by a commercial developer can claim 179D up to every 3 years, as long as they continue renovating the building. And a government and nonprofit building can allocate again to a designer of their building as frequently as every 4 years if it continues to renovate. So, where an architecture firm may have been eligible for 3 or 4 projects a year in the past, it could be up to 7, 8, 9, 10 a year for a given architect, because now they're looking at their nonprofits and they're looking at projects that had already allocated, get to allocate to them again due to that change. So really, really impactful items for designers of government and nonprofit buildings. This new retrofit path that was created, buildings do have to be at least 5 years old, but we help clients understand across their building portfolio what pathway they should go into to get the biggest savings amount. So companies to be thinking about, hey, should we have a plan in place? If you're an architecture firm, you're a design build construction company, mechanical engineer, electrical engineer, or you're a building automation or building controls company or energy services company, it's absolutely worth having a discussion to say, hey, am I eligible for 179D? And how do we put a plan together to maximize that? If it's either new construction, that's great, or if it's a renovation, we'd want to see changes to the heating, ventilating, air conditioning, the building lighting systems, or the building envelope system, being the lights, roof, and other insulation systems. Types of buildings. So again, federal, state, and local are great. Schools and universities are great candidates. Now buildings built on tribal lands can also participate. That's a new change for 2023 and later, as well as nonprofit projects are now eligible. And then commercial buildings that are owned by commercial companies with portfolios of buildings and commercial real estate, you're also great candidates for 179D. It's a very engineering heavy incentive, so it does require the creation of an energy model. And so we have engineers in-house that build that out and do the full analysis and all the calculations of all 8,760 hours of the year to determine the energy savings. It does require a licensed professional engineer to certify the findings and to perform an on-site inspection, given the complexity of the incentive. And we do all that in-house for clients. And this is something that you cannot self-perform. So you can't do your own analysis. You have to hire a third party that's unbiased to do that analysis on your behalf. Again, looking at that case study, now that we understand 179D a little bit better, you can see how it makes total sense that a mechanical engineering firm that worked on 3 projects could get $2.8 million of tax deductions from their work. So again, if you think, hey, I do some work like this, or maybe it makes sense, it's worth a discussion because it can be such a game changer financially for your firm. Real estate investment trusts also now can be interested in 179D. So another piece that's adding interest here. They used to be able to take 179D over 5 years. They can now take it in a single year. So if you are a real estate investment trust and you want a way to control your earnings, you want to have precise earnings control, 179D can be the vehicle to do that. So here's a summary of the various changes. Any other questions here while we hang out on this last slide around 179D? I know we covered a lot in this quick update.
Probably the only question I have is, I know we talked about who could benefit a couple times throughout, but then as your slides went on, it feels like that range continues to grow of who it might apply to. Like I heard potentially roofing in some capacity, but it sounds like if you have a project, it's worth the question.
That's right. That's exactly right. Because the dollar amounts are so large and they're based on the size of the building, if you think, hey, I'm not sure, then that's the time that we should get on a call and talk through the details to determine if there's some great tax savings here. But yep, it is commercial building owners, designers of government nonprofit buildings across the portfolios. And so now we're ready for our first polling question, or sorry, second polling question. Have you researched whether your business qualifies for the research and development tax credit or Section 179D opportunities? Please select one of the options. And now I'll turn it over.
Yeah, and as we wait for the results to come in, Jesse, if let's say that I have a business and I'm interested in having you look into 179D opportunities, what does the prep work look like for me in terms of, documentation and things like that to be in a position to be able to potentially take advantage of this as a strategy?
Yeah, so the documentation, there's not a lot that you need to really begin the process. If you're a commercial building owner and you've built several buildings over the last years, we would want to understand, okay, when was the building constructed? What's the size of the building to really be able to understand and talk you through, does it make sense to pursue or not? If you're an architecture firm or an engineering firm or a construction company, we want to just have a discussion of, hey, what's the type of work that you do? And then we can look up based on public databases to understand the types of projects to see if there's some availability for you to be pursuing these benefits. So not a big lift in terms of documentation to be able to say, hey, we should spend some more time on this and figure out if there's something more to this.
I appreciate that. Jesse, maybe this question is much for Aaron as well. I know we spent a lot of time talking about 179D. Obviously, you work in a lot of other sectors outside of 179D. Is there any other activity, well, we won't get into the details today, that you're seeing a lot of activity in that maybe either surprises you or that continues just to get a lot of questions?
That's a great question, Dan. I would say the big topic of discussion is the R&D tax credit in 174, which is frankly bad tax law, and we expect that to get repealed. But 174 essentially forces companies to capitalize and amortize all R&D expenses over a 5-year period. So there's a number of bills working their way through Congress in the Senate right now to get this repealed. In fact, I saw a TV commercial the other day about trying to get people to lobby their congressmen about repealing 174. And then the other big topic is ERC. Frankly, we're pretty happy that ERC hopefully is behind us, but the IRS put a moratorium on ERC. A lot of confusion about supply chain shutdowns and ERC eligibility. So that would be, I would think, the two main topics of relevance here.
Cool, no, I appreciate that. And it looks like with that, we are moving on to our tax update with Kelly.
Thanks, Jesse and Aaron, for that really comprehensive update of 179D. I think it's a great opportunity for a lot of taxpayers. So going into our 2023 tax update, so there's not a whole lot of new legislation to update with as of right now, which I think for those of us in the tax world has been a bit of relief after the last couple of years with all the new legislation. That being said, we're really just kind of watching to see what's going to happen with the Tax Cuts and Jobs Act in the next couple of years. So when the Tax Cuts and Jobs Act was passed at the end of 2018, a number of provisions were set to sunset at the end of 2025 in order to get enough votes and get it through the budget reconciliation process. Back in 2018, I think 2025 seemed like a really long way away, but looking at the calendar now, it's 2023, and that's only 2 years away. So a couple of things that we're kind of keeping an eye on. The biggest for businesses is the 20% QBI deduction. That's for pass-throughs, so S-corps, partnerships, single member LLCs. That is currently scheduled to go away at the end of 2025. So if you're a pass-through entity, you're currently getting a 20% deduction on your tax return off of your business income. I find it hard to believe that nothing will be done about that, because that is a huge break for pass-throughs as compared to C Corps. And I think we would see a lot of conversions to C Corps if nothing is done to retain something like that for pass-throughs. But unfortunately, I don't have a crystal ball, so we'll have to wait and see what happens there. But that's a big thing we're keeping our eye on for businesses. A couple other things that are scheduled to sunset at the end of 2025. The increased standard deduction was increased with the Tax Cuts and Jobs Act. Personal exemptions were taken away. Those would come back. The standard deduction would go back to where it was back in 2018. State and local tax deduction, that's been capped at $10,000 with the Tax Cuts and Jobs Act. That would go back to pre-Tax Cuts and Jobs Act times, which you could take as much of a deduction as you were able, which would be huge for a lot of taxpayers and higher tax states. The tax brackets would be restructured again. So the top bracket right now is currently at 37%. it's going to jump back up to 39.6 in 2025. And then another one for estate planning is the lifetime gift and estate tax exemption. It's currently at 13 million for a single person or 26 million for a couple, and those are basically going to be cut in half in 2 years and jump back to pre-Tax Cuts and Jobs Act times. So again, we don't really know what's going to happen at this point. We're just kind of waiting to see, but those are some of the big things that, you know, we're keeping an eye on these next couple of years here. In 2023, though, we are starting to see the bonus phase outs are beginning. Bonus depreciation was increased to 100% bonus back at the end of 2018, which has been huge for a lot of taxpayers because you're able to write off the entire cost of an asset in the year that it's purchased. But starting this year in 2023, it's down to 80% bonus. So taxpayers are only going to be able to write off 80% of their asset purchases in that year. 2024, it's going to drop to 60%, 2025 down to 40%, 2026 down to 20%, and then 2027, it's going to be completely phased out. So that being said, Section 179, I just wanted to mention this, can be a really good option for smaller or mid-sized taxpayers. It doesn't always get as much light compared to bonus being 100% over the last couple of years. There are more restrictions with 179. There's a phase out limitation. So that's why I say smaller or mid-sized taxpayers. It's capped at $1.16 million. And then the phase out limitation is at $2.8 million, meaning that if you place in service more than $2.8 million of assets, your deduction is going to be reduced dollar for dollar. So if you're a large taxpayer and you're placing in service $5 million of additions, you'll be completely phased out of Section 179 depreciation. But for smaller or mid-sized taxpayers, this can be a really good option right now, especially with bonus starting to phase out. If you're in Pennsylvania, I'm sitting here in Camp Hill, Pennsylvania, so Pennsylvania is always on my mind. In the past, Pennsylvania has limited Section 179 to 25,000. Starting in 2023, they're now going to follow federal. So you'd be able to take that $1.16 million on your PA return, which is huge for pass-through owners in Pennsylvania. C Corps, on the other hand, have always followed federal. As Aaron and Jesse had mentioned, Section 174 expenses, this is something that went into effect in 2022. I think most of us in the tax world thought this would never kind of come to fruition. This was something that was built into the Tax Cuts and Jobs Act, scheduled to go into effect in 2022. And most of us thought it would have been repealed by now, but it hasn't been yet. As they said, there are bills out there. There's bipartisan support to reverse it. So we are still hoping that happens. But those of you who had R&D expenses in 2022, we did have to amortize those on your 2022 returns. So that's something that we're hoping gets passed here soon, and then we would be able to amend returns and take advantage of those additional deductions there. Again, another update on the Pennsylvania side, on the corporate net income tax side, the tax rate has been 9.99% for a long time. It's starting to be reduced starting this year in 2023. It's going to go down to 8.99%, and then it's going to continue to decrease by 0.5% annually until 2031 when it reaches 4.99%. So it's essentially being cut in half, which is huge again for C Corps that file in Pennsylvania. A couple of things specifically for construction contractors. I just wanted to highlight the adjustments for the small contractor exemption. This is the test that is used to determine whether or not a taxpayer is a small contractor in the eyes of the IRS. And the test is, it looks at average gross receipts for the previous 3 tax periods. And it used to be $10 million. It was increased to $25 million with the passage of the Tax Cuts and Jobs Act, and it's been adjusted for inflation each year. So I just wanted to point out that for 2023, it's up to $29 million. So if your business has been kind of, on the verge there of 25, 26 million, definitely something to take a look at this year, because you might be eligible to be a small contractor. And the perk of being a small contractor is you have more options in terms of your revenue recognition. Generally, contractors are using percentage of completion for tax purposes, but if you meet that small contractor exemption, you do have more options. I'm not going to go through all the detail just in the essence of time, but a big one I wanted to highlight is the completed contract method. It allows taxpayers to defer recognition of revenue on a contract until it's greater than 95% complete. So that can be huge for a lot of smaller contractors. The last thing I wanted to point out, not a new update, just wanted to make a mention of it while we're talking about exemptions here, is the home builder exemption. If 80% of your total estimated contract costs can be attributable to buildings containing 4 or fewer dwelling units or real property directly related to those dwelling units, it can be classified. You can be classified as a home builder. And again, you have more options as a home builder to recognize revenue. You're not locked into percentage of completion. Regardless of what your gross receipts are, if you meet that home builder exemption, you can use something like completed contract method, again, which can really defer recognition of revenue. So that was all I had at this time for a tax update. I'm hopeful in the next couple of years here we'll get some new legislation and some more updates to talk about.
Hey Kelly, quick question as it relates to like Tax Cuts and Jobs Act and some of the things as you're kind of waiting on more information. How is that impacting tax planning at this point, or is it not really because there's not a known of what will happen with that in 2025?
Yeah, at this point, I would say it's not really affecting it yet. We're just kind of watching and waiting to see what happens. I'm kind of a firm believer, and we know what the tax law is today. So if we can defer revenue today, I don't want to say a blanket statement for every taxpayer, but generally that's what we go by. But these are definitely some things we're keeping in the back of our minds, especially with the estate planning, with that exemption being dropped in half, which is huge for higher net worth taxpayers. Yeah, so just kind of waiting and see what happens at this point. And we've got poll number 3 up on the screen. What do you expect to happen to the Tax Cuts and Jobs Act after 12/31/2025? The provisions will be extended in their current form. Provisions will be extended in a modified form. Provisions will expire. What is the Tax Cuts and Jobs Act?
While we wait for the results to come in, I'd love to hear Kelly's prediction on this one.
I'm going to say they'll be extended in a modified form. I find it hard to believe that nothing will be done. I think that would be unpopular. People like to be reelected, but who knows?
Yep, and looks like our audience is in agreement with you there, Kelly. All right, well, thank you very much, Kelly, for that tax update and bringing us up to speed on where that landscape is. So for the rest of our time together here, Dan, Zach, Aaron, and I are going to go through some key reminders for year-end close, some things that you can be doing as you look ahead to year-end to set yourself up well for success with closing the books, and then ultimately to enable your audit or review as may be applicable to go smoothly. So with our top 2 reminders, numbers 1 and 2, Zach's gonna kick us off here and talk about proactive communication.
Yeah, thanks, Tim. So up first, proactively communicating any sort of unique transactions that might have transpired during 2023. Myself personally, I've been seeing a big uptick in acquisitions this year. So just having those purchase agreements and the purchase accounting documents available for your auditor to review, that's always helpful. Next is just being mindful, is it a stock deal or an asset deal? that'll change how the accounting is treated. So just being mindful of that and letting us know. The last piece is just the creation of new entities, having the founding documents available. Are they a related party or a variable interest entity in the company? And is there any sort of consolidation considerations? Will that be rolled up in a parent? Is it kind of its own standalone entity? How does that impact your current audit and your current business? These two items will fundamentally change the financial statements and could impact the bank's perception of company performance.
And I would just highlight with any of these scenarios that Zach described, and I'm just speaking on behalf of our audit review teams, service teams. The sooner we know this information, the better. We can talk through it, work through these things in real time, as opposed to looking back several months. So I know it's very beneficial if you have these to communicate that early on, often, if you're doing a lot of deals. And it also may have tax implications, so that way we make sure we can share that with tax folks as well.
This is my favorite topic when it comes to construction companies, is just prioritizing the year-end WIP schedule. Does the current schedule sufficient story and status of the project? That's exactly what that schedule is trying to encompass. So making sure all of that data is in there, correctly updated as of 12/31 is key. Has the schedule been appropriately adjusted for percentage of completion accounting? And lastly, does the schedule agree to the 12/31 trial balance? Taking a look at that now through the fall and being proactive certainly saves a lot of time when it comes to the year-end financial statement audit. And lastly, is there any other unique additional items that might be impacting a particular project that the audit team should know about? The WIP schedule is a critical driver for the financial statements. If you take a look at the financial statements of a big contractor, you'll often see they're in there as a supplemental schedule. So making sure that we can go from the client to the year-end GAAP WIP pretty seamlessly is a critical part of the audit.
One thing I would add to this slide, Zach, and it's something I think we've talked about in the past, but also be mindful. I'm seeing a lot of evolution with accounting systems. I'm seeing a lot of clients convert to new systems that have a lot of functionality. And I'll be honest, in some cases, they will print out a very nice WIP schedule for you. So your WIP schedule that has been in your financial statements, maybe it's looked the same for the past 10 years, but maybe what comes out of your system looks a little bit different, so it requires some manual manipulation. I would work with the users of your financial statements and see if what comes out of your system can be just as useful to them as maybe how you're presenting it, and save some of that effort in recreating something that may work. There's no specified template for a WIP schedule that's required by GAAP. So we could have 5 different clients and every WIP schedule looks slightly different. So advice here is, if you have a system that's producing nice reports, might be an opportunity to save some manual effort in recreating something new.
Yeah, thanks, Dan. That's a great point. And now I'll turn it over to Tim for bullet point 3.
Yep, so true, guys. The points about the WIP there, for when you're a contractor, all roads either lead to or from the WIP in direct and indirect ways. It's key for external parties, the bonding companies, creditors, from that standpoint in terms of getting that right. But it can also be and is a very critical tool for internal use as well. And one of those ways that the WIP can really help is in terms of telling the story and making the accounting team alert of those unique things that can produce non-conventional accounting outcomes. So you think about day to day, we're chugging along, we're doing percent complete, you know, it's very straightforward in terms of our costs and recognizing those and driving what revenue we're recognizing. Well, in terms of things that can produce unique outcomes, these are the three major culprits that we often see, and it's good just to be mindful of them, particularly when you're closing the books for the year end. So just be mindful of uninstalled materials. You know, if you have some inventory, some materials that you've procured in advance on the job, and you know that those are going to be sitting at the project site as of year end, just getting a good handle on those and the extent to which those will exist as of year end, since those are treated a little differently than your typical costs, and depending on the specifics there. You know, getting a good handle on variable considerations. So what change orders are out there that are pending with the owner? Maybe they're still being negotiated, or you've agreed verbally and now you're just waiting on signatures. Just getting a good picture of those project by project. You know, what incentives can we potentially be earning on the job, and you know, what's the probability of gaining those? And then on the reverse side of things, you know, if there's liquidated damage provisions, you know, is there any likelihood that those will be incurred? Those types of things that require judgments on the part of the accounting team and management in terms of final accounting for that project as of year end. Really key to get a handle on those early on, since those will ultimately drive your entries and then ultimately what's presented on the financials. And then lastly, you know, as it might come up on projects, you know, getting a handle on, hey, was there any significant level of costs that we incurred because we had to rework something this year on any of our projects? So as with these things, you know, identifying them is half the battle. And that's why it's always good to ensure that you're having really good, clear, consistent, recurring communication between those who are out in the field and operations who have that firsthand knowledge of the project, and you know, those on the accounting team that are ultimately going to be depicting and presenting the results of that project in the company's financials. So a few really good forums that can facilitate good discussion between operations and accounting. One is the project review meetings. You know, typically it's probably the case with your process that there is some sort of regular meeting that's happening to go over the state of projects, whether it's monthly or quarterly. So the question there is everybody in those meetings who should be there? So in other words, do we have good representation from both operations and accounting in those meetings? Those can be a great forum to vet out you know, the general status of the job, and as well as those three unique items that we just discussed, making sure that the accounting team is aware of those types of unique things. Project site visits, always recommended, you know, for those that are doing the numbers for the company, to be getting out there regularly and seeing the substance behind the numbers. That can do such wonders for those in accounting when they can see you know, the work behind the numbers and they can make that connection. And then lastly, again, as Dan mentioned, just on the topic of technology, it's pretty incredible what's out there right now, as well as what's coming in terms of resources, tools, like a Procore or similar products that can facilitate almost seamless communication from field to office and streamline that and make that a little easier to make sure everybody's on the same page. Our fifth reminder here, for better or worse, depending on who you ask, our new lease accounting standard is here to stay. So of course, last year, when you were doing your 2022 financial statements, this was the big topic is, hey, we've got to get these operating leases on the balance sheet for the first time this year. And so that was the heavy lift for sure. But now for 2023 and beyond, the key is, okay, we got to maintain a good handle on any subsequent activity from there. So just remember to be, as we close in on year end here, take a look and see, hey, do we have any new leases? Did we amend any of our existing leases? Those types of decisions will impact what you're recognizing on the balance sheet in terms of your lease assets and liabilities, and ultimately drive some necessary disclosures. In the midst of that, of course, always keep in mind if your leasing activity gets to be of a significant volume, a software solution can be very helpful to leverage, and that way your team can keep to the day-to-day the key things like the WIP, which as Zach pointed out is the central piece and the top priority. The more that you can focus on the WIP and not have to worry about some of these other peripheral things, the better. And lease software can really help take a lot of the manual work out of the equation there.
And if all else fails, Tim is always happy to talk leases, so reach out to him.
Appreciate that, Dan. Yes, leasing always, any day. So up to this point here, our list is really focused in on proactive accounting specific items. For these next couple points here, Aaron, would you mind taking us through some more company-wide, broader focus strategic items where our accounting teams can make a difference for the company as a whole?
Sure.
Yeah.
Absolutely. Thanks, Tim. Yeah, number 6 on our list came in at optimizing the timing of fixed asset purchases. Here again, we're sitting at November 16th. We got about 45 days between now and the end of the year. When you place a fixed asset in service for book purposes, not a huge issue whether it's in December or January, but for tax, I'll start off with letter C and B. For tax, as Kelly mentioned earlier, if you put that vehicle in service in December, you're going to get an 80% accelerated tax deduction if you go the bonus route. If you wait till January, you're only going to get 60% accelerated deduction. So really the timing of when you place those assets in service can really have a pretty big impact on your bottom line. Most business owners have had this conversation, but it's always nice to reiterate every year, hey, there are advantages to placing assets in service, and timing is important. And then in point A on this slide, covenant considerations. If you have a limit on how many assets you can place in service, and you are getting close to that limit through the end of the year, it may be beneficial to hold off until January to place that asset in service, so you don't need to violate any of your covenant calculations at the end of the year. Number 7, again, getting ready for employee retention credit. Again, as external accountants coming in, I would classify this as an unusual transaction. It's not something that recurs every year. There are different accounting issues that come up if you did apply for the employee retention credit. When did you apply for it? When did you receive it? How did you record it internally when you received the funds? Was there a component of interest that came with your ERC funds? So really, if you haven't had a conversation with your external accountants already, did we account for this appropriately? Now is a good time to have that conversation so it doesn't come up after your year-end close. And number 8, if you had any adjusting journal entries as part of last year's financial statement prep, go back to what those adjustments were and see if they can be made internally before the external accountants even get there. One, you're going to understand, you're going to improve what your bottom line is, not improve it, but you're going to know exactly what it is, good or bad. You're going to be able to make better decisions for tax purposes before year end. And overall, it's just good practice. Obviously, if there are adjusting entries as part of the external accountants, then something pretty significant was missed. So if you can reflect on those journal entries, take a look at them and see if any of those adjustments can be made internally. Win-win all around. Number 9, learn from last year's audit and review. What were the challenges that went through last year's financial statement audit? Was there stresses either in your internal team or on the external accountants. Did we have unreconciled accounts, or again, as Zach mentioned, a WIP schedule that didn't quite agree to the trial balance? Were we delayed in trying to get support to the external accountants? Maybe this is self-serving, I don't know. But really, what made the process challenging last year, and can we be proactive and correct it this year? New accounting standards, we talked about leases. Again, we're over that hurdle. Open communication with the external accountants. And then we'll turn this back to Dan to finish this up.
Yeah,
Number
it's
10.
over to me. No, I think with any of these things, all the way from 1 through 9, if obviously you have unique transactions, if you have anything that's unusual about the year, or maybe the year just is not looking like it's going to finish how you had hoped, for better or for worse, I think it's always very important to talk to both your accountants and your bank, quite honestly, any users, just so there's no surprises. And I think when you can work through those types of conversations at this time of the year and heading towards year end, it's much easier than it is in February, March, and April as things are coming due to banks or other users of your financial statements. So just emphasize that proactive communication. It goes a long way. I can speak from the accountant side. We are very happy to try to help navigate through some of those situations as they may arrive, whether it's technical accounting or suggestions for discussions with banks and other users. But definitely point that out, proactive communication. I think we're heading up here. We got a couple minutes left, but we did have one question that if I still have Jesse on the line, see if you can answer this question. And it relates to 179D. It says, are the nonprofits factoring this into their building budgets, or are engineers including this as a discount on their services in order to get work? So I guess the question is, are you seeing either of those scenarios hold true, or are you seeing those tax credits kind of after the fact, after those things happen?
Typically, great question. Typically, it's occurring after the fact. We are seeing some nonprofits that are considering this as something they can use as a funding source for a small percentage of the benefit. I typically advise against including it before construction occurs, because you don't know at that point what the benefit amount is going to be. So it's easier to have this occurring on the back end as opposed to in the initial budgeting discussions. But absolutely, it has the ability to be a part of that. It is permanent and significantly increased in benefits. So it's something that we probably will see more of from large, sophisticated nonprofits that are looking to continue to reinvest a portion of those dollars if they can.
Cool. I appreciate that response. As for everyone else, we really thank you for joining us for today's webinar. Actually, let's see, we have one more polling question as I go through the final conclusions here. If you have any questions for our guest speakers from KBKG, you can find their contact information in today's slides. If you have any further questions regarding today's presentation, please feel free to reach out to me or someone else from our team. We would definitely be happy to assist. Recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you that requested CPE and answered the polling questions, those certificates will be sent out within the next 2 weeks. Also want to point out, we do have a couple upcoming webinars. So registration is now open for our upcoming webinar with Bridgeford Trust Company on December 6th, covering modern trust law and the evolving trust industry. And we also have a webinar on December 14th. So we'd ask you to save that date for our end of year tax planning webinar with partner and director of tax, Mark Keith. But ultimately, thank you everyone for joining. We really appreciate your time today and look forward to talking to you further.